This segment deals with business valuation, presented by Tom Johansson, Associate Professor of Finance, Fort Hays State University, Hays, Kansas.
In this segment, we are going to talk about determining the value of your business. This is very important because of the fact that if you obtain a loan or sell your business, you need to have an estimate of what that business is worth. And to define the value of a business, this definition was developed over 50 years ago. It is the value of any stock, bond, or business today is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. What we're really talking about is what the business is going to produce into the future. We don't know that. We don't know what that business is going to produce, so we're going to be making a lot of estimates, and we're going to base those estimates on certain information. And IRS Revenue Ruling 5960 gives us some guidelines on what kinds of variables help us determine what the future is going to look like. The nature of the business and the history of the business is very important. The economic outlook in general and the condition of the industry that business is in. The book value of the business and the financial condition of the business is very important. What is the earning capacity of the business? This is extremely important because earnings going forward is one of the most important variables in the process. Whether or not that business pays any dividends is important. Whether the business has goodwill, in other words, intangible assets, that's a very important part of many businesses that can enhance the value greatly. Whether or not any of the stock or the business has been sold before and what the value was at the sale. And what is the value of a similar business in that same industry? That's also something that we can look at. Now, when we estimate the value, and I say estimate because we do not actually calculate a firm value, we're going to be estimating the value, we need to use certain methods and we make certain assumptions. We are going to be determining or estimating the future cash flows. We are going to be estimating the opportunity cost or the capitalization rate that we will use to calculate the present value. And those are very, very important. We take that information and put those and use certain methods in order to estimate the value. Now there are many different valuation methods that can be used, and I'm just going to name a few of those. When you estimate, when you have so much uncertainty about the future, it's very difficult to actually calculate the present value of uncertain items. So we have many methods. There are what we refer to as balance sheet methods, using certain information on the balance sheet. And there are three main methods here: tangible net worth, economic net worth, and fair market value of the assets. Another category of models that we can use is the capitalization of income methods. These are probably a little bit more valuable, a little bit better than the balance sheet methods, because we are looking at the future possibilities of the company and what kind of money they're going to earn in the future. Two main methods here: multiple of earnings method and the multiple of sales. So the earnings of the business and the sales of the business going forward is very, very important, and we have to come up with some ways of estimating those numbers. Other methods that can be used, and it really a lot depends on the type of business that you're going to be looking at, but there's a price earnings method, excess earnings method, discounted cash flow method, industry market value to book value method, and then many times we use multiple methods and then use a weighted average approach. In all these methods, we are going to be calculating the present value of those future cash flows. And so what we need to do is we need to come up with an opportunity cost or a capitalization rate. An opportunity cost is defined as the rate that you can get elsewhere on a similar risk investment. And Some of the things that go into determination or estimation of this rate include, again, the nature of the business, the amount of risk involved, and the stability of their earnings. If their earnings are very stable, then they're not going to be as risky as opposed to a company that has earnings that go like this. That's kind of risky, and that's going to increase the opportunity cost or the capitalization rate. This is an interest rate, and when we go about estimating this interest rate, we have to think about the components of that interest rate. The first component, and the components of interest rates were set forth many, many years ago, late 1800s, by a guy named Irving Fisher. Those components are, one, the risk-free rate, which we will use either the short-term Treasury rate, the 90-day Treasury bill rate, or the 30-year Treasury rate, which is a longer term. Which one you use really depends on your investment horizon or how long you're looking at going forward. The second component is inflation, and that is a very important component of anything that we estimate, because we know there's going to be inflation. On average, since the mid-20s, inflation has averaged around 3%, but we've seen that change a lot over the years. Late 70s, early 80s, inflation was as high as 13%. So it's a very important variable to include in the process. And finally, the third part of this interest rate also is the risk premium. How much are we going to add to that interest rate to compensate for the uncertainty or the risk of that business? And that can be either very subjective, looking at and estimating what that might be, or we have a lot of data from the past from different types of businesses, and we can formulate an objective estimate. Once we've determined that opportunity or capitalization rate, we apply that and calculate the present value of our estimates to come up with that ultimate value of the business. One of the most important parts of that valuation will be the valuation of any goodwill or intangible assets. And that's a very important part, because we're talking about reputation of the business, some unique method of manufacturing, whatever the franchise value is, what's different about that sets them apart from any other business, and that has a lot of value, and there are many ways to estimate the value of goodwill. What I would recommend is there are many people out there that do this for a living. There are businesses that specialize in valuing businesses. Many people do that and can provide you with a very nice valuation report.